I'm talking with Eng-Teck from Nikko Asset Management about the opportunity that Asian markets present for Australian investors, particularly China and the A-shares, which are now increasingly available to investors offshore.
So to start with, China is already now the second largest stock market in the world if you include the Shanghai and the Shenzhen Stock Exchange. So historically, a lot of investors have problems getting into the Chinese market because up to like 3 years ago, they were on what we call the Qualified Foreign Institutional Investors License. So to get that license, you have to apply to the Chinese government through the central bank, and eventually if you get approved, most of the time you don't get a full quota, but if you get approved, then you have to put the money in immediately. Chances is that your money will be stuck there for a couple of weeks up to a few months. That was a very cumbersome process for most institutional investors. About 3 years ago, the Chinese started a pilot program, what we call the Stock Connect program. So practically in this Stock Connect program, there's a group of approved stocks, almost like 80% of the stock market in Shanghai, and since last year, also 80% of the stock market in Shenzhen. Through this program, what happened is that instead of having to apply for a quota, you actually trade to the Hong Kong Stock Exchange. And you get your money back almost like within 3 days following the Hong Kong system. To us this year is really the MSCI China inclusion. Although very minuscule, and China is probably like the most underrepresented MSCI country in the whole index. Of course, on the other side, you have the US, which is the most overrepresented. China is like almost 5 times underrepresented relative to its GDP. So I think it's a matter of time before China get full inclusion. So what does that really mean for global and financial investors? I think even with a full inclusion, China will get to maybe between 8 to 12% of the global index. It's probably not enough to move the needle for investors to really separately allocate to China from a global investors asset allocator perspective. But from a global emerging market investors perspective, that's where we have to rethink our traditional way of investing, because when a full inclusion happened, China potentially could account for between 60 to 90% of the global emerging market. So I think from that perspective, for global emerging market investors and also from Asia ex-Japan investors, eventually we could end up with a global emerging market index that is ex-China and an Asia ex-Japan ex-China index. So I think that's a consideration that asset allocators in Australia need to consider when a full inclusion happens.
So what are China A-shares, and what does their growing availability mean for investors?
China A-shares is just one asset class. China, unfortunately, is quite a complicated animal. There's A-shares, there's what we call the U-shares, which is the US listed shares. So what typically people separate to in China is what we call offshore and onshore. So the offshore is what you have, the A-shares, the US listed shares. So when you invest in that, which is currently the bulk of the composition of the MSCI China, more than 40% is actually in the internet related stocks, and then you have another 25 to 28% of that in the financials. So in the onshore shares, there is hardly any US listed stocks, because believe it or not, listing on the Shenzhen and the Shanghai Stock Exchange is actually far more difficult than Hong Kong and the US, because they don't allow non-profitable company to be listed, and a lot of internet companies wasn't exactly profitable when they list in the US. So they have very few internet related stocks. What they have is a huge amount of consumer brands that you probably have never heard before in Australia, but is extremely popular in China. Now, if our thesis is correct, and it has been correct for the past 3 years, where China is actually rebalancing its economy from a fixed asset dominant economy towards a more consumption-based economy that has happened at actually an increasing rate, then what foreign investors is getting from the MSCI China is not exactly representative of where the future of the Chinese economy is going. And the A-shares actually can balance that out, because you get a huge proportion of the index that is quite heavily tilted towards the domestic economy.
And Eng-Teck, can you talk us through the process that Nikko follows in selecting assets for its Asian portfolio?
Yeah, so Nikko follow a very rigorous process in terms of how we're selecting stocks. We start with idea generation, where various offices are involved in terms of what we call idea triangulations. We try to absorb ideas from other offices, whether it's in Australia, whether it's in Edinburgh and Japan, and then from there we try to see how it reimposes into Asia. On top of that, of course, we do very intense company visits, company management contacts, suppliers contacts. We do a lot of third-party expert network. So once these ideas are generated, then we prioritize ideas based on when we think that the time frame is going to happen. If we think that it is very urgent, then we would either put the analyst on a plane or to visit the companies and expect the research to be out within 1 to 2 weeks. If we think that this is more of a secular trend, and then we might have a bit more time to do more research. Now, once the analysts churn out the research, they have to present to an investment committee within the team, and then we will put a rating on the stocks. And this rating, if it's a positive rating, go into a pool of stocks where all the portfolio managers within Nikko can select them. So we are quite segregated in terms of duties. The portfolio managers cannot buy any stocks they want, so we are not like a star portfolio manager kind of concept. And the analyst role is really to find the best stocks for the portfolio managers to invest in.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.